Welcome to our presentation for Auditing Concepts Online 2017 Fall Class for Freddie Mac 2003 Scandal. He basically opened the door on mortgage fraud. This is presented to you by Renee Burgess, Charlene Koza, April Morgan, Heather Myers, and Emily Poisel. The history of Fannie Mae and Freddie Mac are indelibly intertwined. Fannie Mae was created in 1938 by Franklin Delano Roosevelt as part of the New Deal. The collapse of the national housing market in the Great Depression discouraged private lenders from investing in home loans. Fannie Mae was established in order to provide local banks with federal money to finance home mortgages. Fannie Mae quickly monopolized the secondary mortgage market. It was privatized in 1968 by President Lyndon Baines Johnson in order to remove it from the federal budget. Like its counterpart, Fannie Mae, Freddie Mac was also created by a president, in this case President Johnson in 1970, in part to limit the monopoly held by Fannie Mae over the secondary mortgage market. Both Fannie Mae and Freddie Mac are government-sponsored enterprises, or a GSE. As government-sponsored enterprises, the companies can generate profit for shareholders, they can borrow funds at lower rates than private enterprises, they're exempt from state and local taxes, they enjoy limited oversight, and they benefit from implied government backing.
Originally, Fannie Mae operated much like a national savings and loan. It allowed local banks to charge lower interest rates on mortgages and ultimately benefited the homebuyer. The market changed substantially after Fannie Mae was privatized in 1968 and Freddie Mac was created in 1970. Fannie Mae and Freddie Mac provided a liquid secondary market for mortgages, which enabled financial institutions to quickly sell mortgages in the secondary market shortly after origination, and freed up their funds to make additional mortgages. Though rivals, both buy mortgages on the secondary mortgage market, both pool loans together, and then they sell them to investors as mortgage-backed securities. Fannie Mae mostly buys mortgage loans from commercial banks, while Freddie Mac mostly buys mortgages from smaller banks, often called thrift banks. As illustrated in this slide, big profits before the crash. It's clear that both Fannie Mae and Freddie Mac made pretty large profits before the market crash in 2007 and 2008. Could it happen again? Both Fannie Mae and Freddie Mac made big profits, as you can see in the previous slide. The federal government spent $187.5 billion to bail out the two companies after placing them in conservatorship in September of 2008. The terms of their bailout agreements require Fannie and Freddie to turn over nearly all of their profits to the U.S. Treasury. They are currently permitted to retain a capital buffer of $600 million each. This level will fall to zero next year. Now, analysts predict that the two mortgage giants would need an additional $100 billion to cover its losses in the event of a new economic crisis. The scandal. As riskier loans become a larger part of the housing market, Freddie Mac lost their dominant role in the market. In order to participate in the riskier lending, they adjusted their underwriting standards. They ended up with a large volume of risky loans. After an 11-month review in 2003, they said they understated their earnings by $5 billion. As we all know, this is not GAAP standard. The review led to resignation of key executive and concerns by lawmakers and regulators. Former executives had manipulated numbers in order to meet investors' expectations. The size of the misstatement caused regulators to be even more stringent. Why did they need to manipulate their numbers now? Well, Freddie Mac and Fannie Mae had a dominant position in the home loan market until Wall Street started buying riskier loans. Many people who didn't qualify for a loan previously could now qualify with other mortgage companies, causing Freddie Mac and Fannie Mae to lose their position. Many of those loans were large, over 100% equity. They were made before the housing prices started to drop, and as a result, a lot of those houses were foreclosed on. Freddie Mac also adjusted their underwriting standards in order to participate in the riskier loans. A lot of the risky loans were large, made before the housing prices started to drop. So basically, the bottom line was their business was 100% in the housing market. So when it fell out, they were in big trouble. They received $71.3 million in bailout money. Combined with Fannie Mae's $116 billion, this was the largest bailout in U.S. history. Well, Mr. Auditors, what went wrong? Well, Arthur Andersen needs to tell a little story about derivatives. To start with, Arthur Andersen, as the auditors, well, they failed to be an impartial auditor and separate their interests from those of Freddie Mac. There's this thing called derivatives. Let me explain. Companies can offset certain gains or losses with similar gains or losses in the derivatives used as hedges. The combination of these two standards allowed Freddie Mac to spread out their earnings or amortize them over the life of the derivatives to make them seem less volatile. This is also according to the Statement of Financial Accounting Standards 133, which deals with assigning current market values to derivatives and hedges while recognizing that these changes are going to be reported on the balance sheet. A few of the things that affected Arthur Andersen's independence was the length of the relationship they had with Freddie Mac, the amount of fees or money from audit jobs and non-audit jobs, and questions of employment between the two firms. With such a long relationship between the two companies, it makes it hard to believe that the auditors did not form relationships with the employees and upper management at Freddie Mac. This is a problem because it affects the auditor's ability to give an impartial opinion on the company when performing their audit. When a firm is receiving such large amounts of money from a client, they are more likely to do what it takes to retain that business. Freddie Mac was Arthur Andersen's sixth biggest client. In addition to this, Arthur Andersen received $5.8 million in non-audit fees, such as consulting. This is another problem, as an audit is meant to be external, and if Arthur Andersen was doing additional accounting consulting work for this client, they have an even bigger reason to make the client happy. Another thing that's interesting is Gregory Reynolds and John Woods both joined the Freddie Mac company directly from Arthur Andersen and took upper-level positions. When auditors end up working for the company they used to audit, there's a greater chance of collusion with the audit team when they come to do their jobs. What were the effects on the business and accounting world and investors? Well, essentially in 2003, Freddie Mac was caught in an accounting scandal where they understated their earnings by nearly $5 billion over 3 years. Former executives apparently manipulated Freddie Mac's earnings to meet investors' expectations. The main problem was that Freddie Mac did not correctly account for derivatives transactions intended to hedge against changes in interest rates. They had to recalculate on a quarter-by-quarter basis to their market price. The value of transactions changed, although the value of the assets that created the interest rate risk did not. The volatility that this created was not against the company's financial position, but was a function of accounting rules not being applied properly according to GAAP. The law firm that the board of directors hired provided support that the executives were aware of some of the transactions used to transact earnings improperly. Most executives that were at Freddie Mac are no longer with the company and include the CEO, the COO, and the CFO. Freddie Mac was penalized $50 million to settle civil securities fraud charges brought by the federal regulators due to a 4-year accounting lapse. Freddie Mac never admitted or denied any wrongdoing, but did tell the Securities and Exchange Commissions that it agreed to refrain from any future violations of SEC laws. Stockholders' equity of Freddie Mac rose by $6.7 billion after the reinstatement, largely because of retained earnings that had been understated. Shares of Freddie Mac stock rose 3 cents after the numbers were revised. The scandal with Freddie Mac is different from other corporation scandals such as Enron and WorldCom because Freddie Mac understated profits instead of overstating profits and assets. The scandal wasn't to cover up the company not doing well financially, but to smooth out quarterly reports. Either way, it was against GAAP rules, but at least investors didn't lose in this situation. All in all, there weren't too many consequences. Really no legal time spent by anybody. $125 million was paid directly to the Office of Federal Housing and Enterprise Oversight. The CEO, the CFO, and some VPs were fired from the company, and a total of $515,000 in civil fees and $275,000 in change in restitution were ordered to be paid, and everyone was charged with negligent conduct. No one was convicted.